Let's delve into the retail sales number that was out, 5.6% year on year in February. It's, of course, coming in slightly worse than most had expected, and that's from a revised number of 6.3% in January. Is this a disappointing figure for you, Peter, or do you think it was largely to be expected?
Well, the data is clearly volatile normally from month to month, but it was definitely a disappointment and a turnaround in the direction we're expecting it to move. I think there were perhaps a few small signs from a slight slowing down in credit growth the month before, that sort of thing. But in reality, we should be in a recovery phase here, given what's going on in terms of employment's now growing, wage growth is growing again. So it does definitely come as a bit of a surprise, and we need to wait to see if this is a trend. If this is a trend to lower growth rates, I think then that does start to become more concerning for the SARB. But overall, the retail sales number probably fitting in with the SARB's overall picture in terms of a lack of demand-side pressures that can feed through to inflation.
With regards to how this is going to shape monetary policy thinking going forward, and one cannot look at the retail sales number in isolation. We also have to look at the CPI number that came in slightly higher than most had expected at 4.1% for March. Peter, do you think that we are going to see much higher inflation and perhaps softer retail sales figures as well, and this putting the monetary policy decision in a difficult space?
Well, that CPI surprise today came very much from food prices, particularly some unprocessed foods. And I think as such, the MPC will look through it. They are obviously looking at headline CPI to some degree in regard to how it flows through to expectations. And in terms of a general overall sort of sense of credibility, if you like, of keeping inflation within target. But really what they're concentrating on, I think, is more core inflation. And that's still very low. It's still around 3% for the CPI, ex-food, ex-energy, ex-administered prices. Still very low print there. And that's, I think, really what they'll be concentrating on. Because at the end of the day, the three main things they're looking at are employment and employment growth through the recovery, the state of private sector investment, and second round effects in CPI. So it's actually interesting if you consider within their reaction function, if you like, what is more important, the retail sales number or this CPI surprise. It's actually probably more the retail sales than the CPI number.
So then can we comfortably say then, Peter, that the Reserve Bank is, of course, going to start ensuring that the growth picture in the country looks stable before we start seeing a hike in interest rates? How do you think that is going to play out? And if we allow the inflation figure to breach the 5% level, we could see negative real interest rates in the country if we do not hike that repo rate number, which is sitting at 5.5%.
Exactly. We are going to get, I think, a little boost in the economy through the middle of this year from falling real interest rates. And the SARB know this full well, I think. I think there's a number of important factors to consider in terms of the timing of the start of the MPC hiking cycle. And my view here is very different from many locals. Many locals are looking for rate hikes earlier. I think actually the risk is to them being later, albeit my baseline is still for a start in November. But they, as you say, they are looking for a sustainable recovery. That's why they're looking at private sector investment. That is recovering very sluggishly. In my forecast, it probably won't be until Q1 next year that we start to see more solid growth numbers on that front. And in terms of employment as well, which they're looking at, we won't reach back to the levels of peak employment we saw in the last cycle, probably until the middle of next year into Q3 of 2012. So that's clearly, that's a number of factors that will be keeping them on hold for as long as possible. And you combine that as well with the fact that I found out on my recent trip to see the Reserve Bank, they are happy with being late in terms of hiking rates. So once again, that's all showing they're willing to give that little bit of stimulus into the economy from real rates.
With regards to the most recent news flow out of the Treasury, the new Director General of the National Treasury is Lungusa Fuzile. Looking at this new appointment, Peter, clearly this is just news that has come out a few hours ago. Do you think that we could see any significant moves, any shifts that perhaps towards the left, or do you think that what we've been seeing from the National Treasury and from the Reserve Bank is pretty much intact for now?
Well, in terms of investors' perspective, Lungisa is definitely a great appointment as Director General. He's very well known here in London by investors. I met him on numerous different occasions. He's a very nice chap, first of all. He's also very experienced in National Treasury, having held a number of different posts in different streams, if you like, of policy within the National Treasury. I think he is a sort of a solid, if you like, pro-investor, pro-business sort of guy overall. So I don't think in terms of policy within the National Treasury we see any shift based on his appointment. And I think he will indeed do a very good job in filling the very large shoes that the Setia will leave behind. But I think the more important case and issue around the National Treasury is the shift of power away from National Treasury towards economic development and the DTI. Arguably, that's probably beyond his control, beyond Lungisa's control. That's a much more political thing that happens in the cabinet. That's very much up to Pravin Gordhan, I think, in terms of trying to wrestle back that balance in favour of the National Treasury.